At the current share price, Diageo has a market valuation of £63 billion. It's got £1.4 billion of cash on the balance sheet and almost £16 billion of debt for an enterprise value of £77 billion. Over the last 12 months, the company has produced £17 billion of revenue and £3.7 billion of net income, which means the stock is valued at 5 times revenue and 17 times earnings, well below the historical average. 17 times earnings is cheap, considering that Diageo is one of the largest drinks companies in the world. In fact, the company owns the #1 brands across whisky, scotch, vodka, rum, tequila and gin. Drinks like whisky and tequila can take 10 or 20 years to produce. That gives Diageo an edge, since it takes new entrants a long time to get started. In a recent event, Diageo management gave an optimistic forecast for the years ahead. According to management, the alcoholic drinks market should grow by 4% a year, and spirits should be the fastest growing category, ahead of beer and wine. As a result, Diageo thinks it can drive annual revenue growth in the region of 5 to 7% a year. So let's assume that Diageo grows revenue at 6% per year for the next 5 years, then operates with a similar net income margin of 22%. In that scenario, it would be producing $5 billion of net income in 5 years' time. If the PE multiple moves back up to 22, the valuation comes in at $110 billion, which works out to an investment return of 11.8% per year. Include a gradually increasing dividend, and the annualized return could be almost 14%. That return suggests that Diageo is approaching a buying opportunity. However, there are risks to be aware of. A recent profit warning in Latin America suggests that sales in that region could drop 20% next year. And despite Diageo's optimism, there is conflicting evidence over the consumption trends of alcohol. Recent data shows that young people in the US are consuming significantly less alcohol. That's a problem when 37% of Diageo's sales come from North America. In addition, weight loss drugs like Ozempic suppress the desire to drink alcohol. That may seem insignificant, but the impact of super consumers could create an outsized impact on the sales of alcoholic drinks. For example, according to the Washington Post, the top 10% of Americans account for over 70% of US alcohol consumption. Diageo is a company that has proven to be resilient over the last quarter of a century, and the business has big opportunities abroad, in India, China and Africa. However, the changing outlook towards alcohol consumption means this stock could have further to fall. For that reason, I give the stock a neutral rating, but these are my personal opinions, not financial advice, and I've got no position in Diageo stock. To see more videos, visit my website 3minutebreakdowns.com, and thank you for watching.